Hello, everyone. Welcome to the Weekly Watch. I'm John Briggs. This past week was highlighted by the Fed meeting where they hiked rates by an expected 75 basis points. And similar to the ECB, they dropped any near-term forward guidance. With a backdrop of recession fears amongst investors, I saw Powell's overall message and tone as generally upbeat. It said the labor market was extremely tight, aggregate demand remained strong, and inflation remained his top priority. He did recognize there were some concerns around growth, but continued to say that slower growth was needed to create slack in the economy. So overall, a hawkish tone. But there was one line that markets took as dovish and which determined the price action of the day. And that was that he expects the Fed to go modestly restrictive. So if you think a neutral policy rate is around 2.5%, then that comment means that anything over 3.5%, ballparking it, is probably unlikely. So you shrink that upside probability and price out any major chance that rates are going to rise above there. So that naturally puts some downward pressure on front-end rates, and that's what we saw. This was in turn boosted equities, and both the rate and equity move weighed on the US dollar. Now, I understand this reaction, and despite the increasing worries about growth that was sparked by the weak US GDP report this week, I worry that these moves could be fleeting. Simple fact is, Powell's now guiding the market, not in the short term, but his expectations about a terminal rate some 6 to 9 months from now. Again, I understand the market is reasonably clipping off some of those higher probabilities of higher funds rates, but I'm not sure we should put a lot of faith in his view in that, given the underlying inflation dynamics, which continue to surprise the upside, the simple uncertainties that exist not just on a 6-month basis, but really on a 6-day or 6-week basis at this point. So bottom line is we don't actually see inflation coming down quick enough to validate that guidance. So even with all these worries around growth that we're seeing lately, the inflation side is what is going to dominate in our view. And so we think that's fragile guidance indeed. But that's the Fed. And up next is the Bank of England. And here I'm going to bring in NatWest's chief global economist and chief UK economist, Ross Walker. Hi, Ross. Thanks for joining. So you have the Bank of England next week. First, let's just start with a basic overview of what you see them telling the markets.
Well, it feels like another very close meeting. We expect a 0.25 point rise. Market is pretty much fully pricing a 0.5 point increase. And there's a sort of, at the moment, 2-to-1 ratio in terms of economists in favor of that larger move. So there's the rate decision itself. We expect some update on QT sales. But as you say, the key thing in many ways, I think, will be how they update their guidance. Firstly, we're approaching levels, or we'll be at levels, essentially where they had previously signaled this was terminal rate type territory. So if they do deliver a rise, if there are further rises envisaged, they're going to have to update that guidance and give us a bit more clarity on where terminal is. They had the luxury in previous meetings and reports that as they were still some way from that 1.25%, 1.5% territory for bank rate, there was no great pressing need to give greater clarity, but that's clearly upon us now. And in general, their guidance got a bit hazier in terms of the near term. Alongside that, they had this more hawkish medium-term guidance. They would act forcefully if required. So again, some more clarity on where we go from here. But I suspect it's going to remain quite hazy. I think, as with the Fed, the BOE is just less comfortable with this sort of idea of sort of hand-holding markets and steering markets more precisely, because it's quite simply the path, the outlook for rates is just less clear from here.
So let's talk about that path a little bit, and terminal rates and everything. The markets are moving quickly. So as of this morning, had a base rate going up to around 2.75% by December. What's your view on the, the eventual path?
Well, that feels very aggressive to us. And of course, if you look at the market profile beyond that, markets by around the middle of next year are starting to price in some fairly meaningful cuts. So why would the BOE tighten excessively in the near term to embark on a rate cutting profile as early as the middle of next year? So the market path in many ways doesn't look that plausible, unless you think the BOE is going to naively stumble into an excessive tightening type policy error. So I think from here we still see risks of some further tightening. But I think the key thing to emphasize with the UK is how slow and how partial the pass-through from bank rate rises that have already been delivered has been to actual household debt servicing costs. If you look at advertised mortgage rates, yes, they have risen quite substantially, in some cases more than bank rate. But if you look at, because we have such a high proportion of fixed rate mortgages, the proportion of households that have actually reset their mortgages to those higher rates is very low. And the BOE's own data shows that of the 115 basis points of bank rate rises since they began raising rates last December, only about 10 basis points have actually reached households. So this is still a very, very limited pass-through. And quite simply, I think a little bit more patience is needed. And I think the BOE obviously understands this. And that's one of the reasons, or the main reason even, why we lean towards just a quarter-point hike on the 4th of August. And beyond that, that the BOE continues to move quite cautiously in quarter-point steps to a peak of around 2%.
Yeah, it almost feels like, especially with all these growth worries coming up to the peak, they might get a little bit more of a pass on that versus a few months ago when it was all about inflation. You mentioned QT quickly. Anything we should be thinking about there?
So we'll get more detail alongside the monetary policy report about how the BOE intends to go about its QT sales. They have said, the governor has said that they could have a vote as soon as September on whether to actually begin QT. And the fact that he mentioned that September month suggests they're keen to get this going. Operationally, they're ready. So we brought forward by a few months our expectation for the start of actual QT sales to October, looking for about £35 billion of active sales per year, probably spread relatively evenly and done in a similar way to QE in terms of those maturity buckets, spreading the sales relatively evenly. So 35 billion of active sales alongside a natural runoff over the next year of a similar magnitude, around 35 billion, 70 billion a year, just under 10% of the stock.
Just quickly, anything new on the political front? Just thinking in my mind that these potential promises for more fiscal easing, or is this just something the Bank of England is going to watch for?
So the leading candidate, Liz Truss, has unveiled already £30 billion of essentially unfunded tax cuts. Most of those probably take effect in the next financial year, next April, but some could have more immediate effect. So clearly the BOE would have to take that into account. Some of those tax cuts are centered on the corporate sector, so they would have less immediate demand and inflation implications. But others, such as the national insurance reversal, cutting the green levy on our domestic energy bills, those would feed through to consumers more quickly. So there would be some additional monetary tightening, presumably required by that. Typically, of course, the BOE will wait until those actual policy announcements, if you like, have been confirmed or legislated. So I don't think they necessarily run this with more aggressive monetary policy tightening, but it's certainly a risk, and there's certainly the case that without that additional fiscal stimulus, rates would not need to rise quite as much.
Okay, great. Thanks, Ross. Thanks for joining us this week. That's it for this week. Personally, I'm hoping the passage of that last major central bank meeting in the Bank of England could bring some calm to markets, but I think that's probably too much to ask, given volatility doesn't necessarily even seem to be going away. It's not even getting any lower. It seems to be going up, if anything. As for events, I'm watching to see if the Fed speakers push back against these recent market moves, with financial conditions loosening in the face of the Fed. And in the US, you get the usual headline data, including the next payroll report. Globally, we see PMIs, and Europe has industrial data and a few other indicators. Notably, we continue to go through the latest round of earnings season. So that's it. Thank you, and have a good week. Thank you for joining us for this episode of the Weekly Watch. As always, please remember to hit subscribe so you can watch our latest episodes as soon as they're available, and hit the like button so it's easier for others to find it.